This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Krista Morgan, general partner at Stage and founding partner of Stage Fund. Stage makes control-based investments in businesses that have proven market traction but need a new approach and capital partner to get to the next level. Stage is a turnaround venture fund that offers early-stage, small and medium-sized enterprises both the capital and management expertise to rethink their approach to growth. Krista, thank you for joining us.
Thanks for having me.
So tell us more about your background before investing in early-stage companies.
Sure. I founded an early stage company. So I ran a fintech company for about 10 years. And interestingly, it was in the lending space. So I built a loan portfolio, managed almost $100 million. We put out about $1 billion of financing over our history. So got to see a lot of other early stage companies along the way. So I think that background has really helped me as I move on to the investing side. I've just seen a lot of companies at that Series A, Series B stage, and what can go wrong.
Well, great. So what excites you right now?
It is an interesting time. COVID, lots of change going on in the world. I am excited about, I think the early stage, especially the Series A, Series B market is going to change and evolve as we go through this period. I think there'll be more focus on cash, profitability. I don't know how quickly all the venture money will come out. Where I was reading an article saying that, Series B rounds have been down 45% this year, which is pretty substantial. So I think companies are going to, be trying to figure out what to do. And I think that always leads to creativity, in the space, which I think is great.
Absolutely. Well, so you've seen a lot of startups and you've done a lot of investing yourself. What's your advice for people investing in startups in this area? What do you tell them to do before they write that check?
I don't know. I would say I have probably the biggest thing that I do, differently now is I really, really dig into the balance sheet. And I make sure I understand how much of the investment is going to commitments that have already been made versus future growth and investment. I think, especially a lot of companies, as they try to get their rounds done, they're accruing a lot of accounts payable, a lot of, okay, we'll pay this once we get our funding. And really knowing, if you're doing a $3 million round, is $1 million going out off the top to pay for previous commitments? I think, and that may or may not change whether you invest, but I think it's really important to understand.
Cool. And then, so on the other side of that table, what do you tell startups to do before they go out to raise that first round?
First round, I think raising your first round is really hard. I would say, as always with the biggest thing we run into with entrepreneurs, especially when we're talking to an entrepreneur that's run into some difficulty, which is usually why they're coming to us, the biggest thing they don't have a handle on is really understanding their cash and having been willing to make some tougher choices before they started fundraising. They're kind of looking for fundraising to solve their problems instead of solving their problems and then raising funding, which actually ends up being a lot easier.
That's a good point. So you're talking about investing in the Series A and B market segment and that's going to change. Let's talk about that and talk about just the state of investing. How do you see the industry evolving and why do you think the Series A and B is going to move to profitability?
Well, it is hard for a Series A, Series B company to be profitable because investors historically have just been all about revenue at all costs. So I think change has got to come from both sides of the table, as it were, as investors not necessarily encouraging this all revenue is good revenue and revenue, even if it's unprofitable, is still good. Just changing the expectations there, I think it's going to become important because I think investors are going to be asking, how far can my money really go? And from our perspective, so, what we're doing is coming in usually once there's already been a Series A or Series B round. So when investors come in, there's often been 20, sometimes $30 million into a company. And all of a sudden, the company focused solely on growth. They got to this stage that was somewhat unsustainable. And the investors are like, well, we're just gonna walk away, and the company kind of gets left, in the dust. And I just really think that that's gotta, like, this model is not working well. Like, because we're creating all these, we call them orphaned companies, companies that are fundamentally good businesses, but maybe they weren't going to hit that unicorn status. And so then there's gone, that money's gone. And we're like, why waste all that capital along the way?
No, that's a good point. And so what's the biggest change you see coming up? Where do you think what's going to be the next big thing here?
I think going back to some of the data, I just think we're going to have had COVID is going to have impacted us for probably almost 18 months by the time. And then, there'll be sort of economic shifts on the back of that, changes, like lifestyle changes, things that'll be impacting. Like I said, we're already seeing Series B rounds are down 44% this year. I am not expecting that number to improve over the next really at least 12 months. So I think there's going to be a change in how people are thinking about capital and capital efficiency and what's really important to spend on.
Right. Well, tell us more about your investment thesis. And it seems like you're doing more turnarounds and so forth. Tell us more about how that works.
So my partner, Dan, started Stage in 2009. So this is I've come in to help him put together his first committed capital fund. But he's been doing this for a long time. And generally the thesis has been he has worked with, and we now work with, often venture debt lenders. So we work on the lending side. So we go into banks, venture banks, sometimes alternative lenders, and who are lending to these companies before they're profitable, usually on the back of equity. So like often the lenders come in alongside an equity partner to provide additional capital. The company itself can't sustain the debt. So, what we do is we work with the lender once the equity has said we're no longer going to come in. The lender's going, well, we got to get our money back somehow. And so they call us in, and we often, are restructuring the debt, restructuring the cap table, putting in new equity and management expertise to really get these companies, take them from this growth at all costs venture model into something that looks a lot more sustainable, that is still can be a very good exit. And so so the thesis is really, usually there's been enough capital invested in the company that the product is good, they have some good customers, that this is something that can be sold if it is managed correctly. And that's what we focus on doing.
It sounds great. Do you have any startups that fit that thesis that you can call out, maybe one or two portfolios or one or two examples?
Yeah. So we've announced two acquisitions so far. The first one was a company called Needle out of Utah. They raised over $20 million of venture. They are in the e-commerce. So they have e-commerce chat solution. They provide basically contingent labor and technology for brands to be able to staff their e-commerce chats. They don't have to do it in-house. And the company's been around for a long time. They did well, but, just hit some roadblocks. And in the end, their equity pulled out and the company was kind of stagnant. And we came in alongside their lender and helped do a restructure. And now, what we have at its core, we have some solid customers, we have a good revenue base, and we are investing heavily. We're going to be investing in sales and marketing to kind of get the company back on a growth path. For us, we think this can be turned around and sold within 3 years to someone, either someone doing a roll up in the space or, to a strategic acquirer. So that's one example. And it's gone It's gone well so far. So far.
Well, that's good to hear. So,
Yeah.
so as you work in this space, what do you think the main challenge these startups face? Is it debt, or what else is really the issue there?
I think there's just a lot of over leverage. I think we've spent
Mm,
the last 10 years, there's been a lot of capital and a lot of people trying to deploy capital from debt, equity, various other, interesting structures. So a lot of what we're seeing is just companies that are over levered. Really, they are dependent on the growth to keep this they're on like a hamster wheel, right? So it's like
yeah.
they're dependent on growth to solve all the problems, growth and or more equity capital. And then as soon as one of those things or both stop happening, things fall apart very quickly. And they don't know, they just don't know what to do. And I can say this, I say this to founders all the time. I mean, I have been there. I did that, right? I sacrificed all kinds of, I made a lot of decisions as I was running, my startup. I was like, growth is the most important thing, and we have to do this at all costs. And looking back, I would do it differently, just because to be running a business, and not to say that you can't be burning cash and growing, because I think at a certain point you have to do that. What I think is important is like not getting your fixed cost base so high. Look at these, we're coming into companies where they have massive leases, they have they've just made a ton of commitments that are really hard to unwind. Whereas I think if you can, if I were to do it again, I'd really be building a business with a more flexible cost structure in mind, so that if something does go wrong, like you can downsize if you have to, which it happens to all of us, So
Yeah.
I think that's important.
Well, who knew 2 years ago we'd go through a pandemic? You don't know what tomorrow brings for sure.
Exactly.
And so on the other side of that table, what do you find the challenge the investor faces in today's investing climate?
Well, from our perspective at the Series A and Series B stage, what we have found is, and I think as we talk to we work with a lot of investors in this space, you don't have a lot of control. Is it strange that we're control investors at that stage? Absolutely. There's not a lot of people doing that. At the same time, if you're not in control of the cash, it is very hard to manage where your investment is going and really what the impact your investment is having. So we would our thesis is that by writing a larger check, and the check, typically an upfront check is called from 1 to 4 million upfront, and then we reserve to do follow-on investments. But we want to make sure we know how that cash is going to be spent. And having that control position means we can let the founders do what they are great at and be visionaries, but we handle their back office finance, we handle HR, we monitor hiring. Like, we're just able to make sure that no one gets kind of out in front of their skis.
Great. Well, you see a lot of different sectors and applications out there. If you had to pick one or two in this area of Series AB as good places to invest, what would you call out?
Good question. So we've now, both of our first acquisitions are in the kind of technology enabled services, but that have a contingent labor force, sort of giving opportunities to people to work from home, work remotely. And we really like that space. And we've invested both on the e-com side and retail. I think retail is going to come back. I don't know that it will look exactly the same, but I do think it's going to come back. So I think there's some interesting spaces that are being undervalued right now just because of the pandemic. So there's probably some good deals to be had. The other space that, we really like is CPG. We like that. We like consumer product companies, especially right now, anyone in that direct to consumer space, because it has been growing. And so we like that. And, and then always B2B SaaS. I mean, I think, especially right now, right? But again, those companies have done pretty well. through this time. So for us, it's all about how far can our money go, right? Like we really look at this stage and say, we're not interested in being in the companies that are everyone says is going to be a unicorn. And like, so you're paying a much higher valuation. Like we'd rather come in at a stage, get better valuations, and have something that's maybe less exciting, but something that we can look at and say, this is a solid business that has reasonable margins and good unit economics. And like this business can get to a certain level of scale and be valuable to someone else.
Right. So you mentioned CPG. Is there any particular sector inside CPG that you find attractive?
We've looked at, so part of my background, because I was in receivables financing and we were in Colorado, there's a lot of food and beverage in Colorado. So I like that space. We're actually looking at a cheese company right now, which I'm pretty excited about. And again, in CPG, the valuation, especially in the early stage, tend to be lower compared to tech. And it tends to take often all that capital that's by the time we come in, there's usually a good product. They've got some distribution. What they really need is just to get sales and marketing going and like push the brand out. So we think it's just a pretty straightforward value proposition. And we see companies getting acquired at 5 to 10 million in revenue by brand. So again, we like companies that can be acquired at that kind of revenue level, that we don't necessarily need to get it all the way to say 25 million.
Okay.
For it to be attractive to someone.
Well, that's great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I don't know. I guess all I would say is I think I hear from a lot of investors right now when I say we're in distress or turnaround, and they're just like, oh, I don't like doing these messy deals. I don't like deals where you might have to put more time into it or whatever it is. And honestly, what I'm saying is that is where there's so much opportunity. And if you find the right team, they can really benefit from having active investors who are guiding them, really helping them make better decisions, because it's hard when you're in it. Having been a founder, it's so hard to see the forest through the trees, and I was joking with my other partner, Ingrid, because we were both founders before we moved to the fund. Like, we're like, man, it's so easy. Like, we look at these companies and within 10 minutes, we're like, this is absolutely what you have to do. And we never could do that for our own businesses. And when you find the right founders, like, they're great folks. You're saying, you're really helping them like get to a more sustainable place, which doesn't feel quite as sexy, but it feels like you sleep a lot better at night when you're not just burning cash and worried about it.
Cool. Well, that's great. Well, how best for listeners to get back in touch with you?
LinkedIn and email, definitely the best ways. So happy to connect.
Great. We'll put those in the show notes. Want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.